Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, June 14th, 2023, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper Excel 007, and we are going to touch on a couple of topics here. They're all going to stem a little bit from our discussion last week on crypto tokens and unregistered securities and the SEC. And so the first one is, what's been happening? Has there been any large events relating or surrounding this? And there has, and we're going to touch on that. Then we're going to show and discuss a little bit about reality is really relative. It's not absolute. You might think reality is absolute, but it's really from the perspective of that individual that is perceiving the reality. And then lastly, we'll just really kind of wrap up and pull in the importance of making sure that when you're trading your strategy on your terms and your rules, and you own those things. But before we hop to that, I want to give a shout out to our Discord, link in the description below. Click on that. You can join our Discord, say hello to myself, Viper, a few of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You can also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. This is also available wherever you get your podcasts, so you can consume us in an audio-only format. And if you can't find it, let us know and we will get it there. But let's hop to this week's content, Viper. Viper, last week we started dissecting some of the SEC's lawsuits that were raised against Binance and Coinbase. Where are they based on? We actually started talking about, the Howey test and where an unregistered security kind of fits in, and then what it means if you are an exchange, a centralized exchange providing these unregistered securities. And that's really what the SEC seemed to be cracking down on. In last weekend, I remember, I don't remember if it was Saturday morning or Sunday morning, I happened to look at some of my crypto holdings, and I was like, holy smokes, what the heck happened? And I noticed that the AVAX, which is one of the tokens that I hold a few of, and it's one of the technologies that I'm a pretty big supporter of, had just dropped like a rock overnight. And I messaged you and I said, what the heck is going on? And you said, oh man, it's across the board. It's all these alt tokens. So yeah, talk us through what we saw on that time and what tokens were impacted, and let's theorize a little bit about what might have been going on.
Yeah, it was, it wasn't great. It wasn't enjoyable. And we'll get into that part of it a little bit later, but yeah, it was Friday night into Saturday when it actually happened. I actually had just laid down to go to bed, and then was just doing kind of a one last check, of just saying goodnight to everything, I guess. And I happened to load the AVAX chart as it was happening. And part of the reason I was checking was just before I went to bed, I looked, and like we were up around $14, I think. Just over $14, hovering around there for the end of the last week. And we started dropping really fast through 13 and into 12. And then there was a brief pause in 12. And so I was like, oh man, like, wow, that was fast. Like, just went right through 13. So that was part of why I checked up. But I checked in again, and like, then it was just when you look at just a bloodbath chart, when there's just sizable chunk. And I was like, I just kind of froze. I was like, what is happening right now? But like you said, initially I was like, just kind of quietly, okay, put the phone down and just try to go to bed. Like, we'll deal
Sweet
with that.
dreams.
We'll deal with that in the morning. So I had no idea what was going on, but I was like, I'll look and see what everybody's talking about the next day. So backing up slightly, mid to late last week, what we started to see was obviously, like we talked about on the last episode, that these filings against Coinbase and Binance are coming out, and the filings are finally naming specific tokens, naming them as unregistered securities, like we talked about last time. And what I find most interesting is, again, like we talked about, that these filings are breaking down why that token is considered an unregistered security. So once you get through all of the fluff and stuff of all the maximalists that are like, you can't do this, that's not a, like, the people with money, the people with real contribution and power to swing these charts, they don't care. They're not looking at this like, I don't think this is a security, so I'm gonna, they just want to do their business, whatever they're doing, and they want to do it on their own terms. So what we kind of saw was, as this is coming out, you're starting to see things like Robinhood made a release saying, hey, we're gonna stop offering Solana, Matic, and ADA, Cardano. We're going to stop offering these on our service. You basically have until June 27th, I think it is, settle up your trades, do whatever you want. But if you're holding any of these tokens on our platform by this date, you're immediately going to be sold. Those assets will be sold and converted back to US dollars. We're done with this. And so that started happening across the board, because again, these platforms don't care. They see what somebody else is being penalized for, and they say, we don't want any of that. And so we're going to step back. If we take a look and just see how significant this was and how much it kind of reinforces this theory, these are four of some of the top, like you said, alt tokens, alternative tokens, and that's a phrase that's kind of used to be alternative to Bitcoin, and in some cases people would say alternative to Ethereum, ETH. Though some people would also say ETH is just an alt as well, and Bitcoin is the only thing. But nonetheless, the prevailing usage is to mean anything other than Bitcoin or Ethereum, which is a little foreshadowing. So here we see Matic and Solana and AVAX and Cardano, and these charts are brutal. I mean, these are all 35 on Matic, 30 on Solana, 30 on AVAX, and again 30 on ADA. And this was across the board. So I mean, Dogecoin, everything you can think of, just got massively pounded in this same period of time. And I mean, you could look into
short
it.
Period too.
Yeah, very short. It was like, because like I said, I looked at it and was just paralyzed. Really wish I was just a little more clear-headed, because I had money at the ready, and I watched $9.90 AVAX, and I could have pulled the trigger on that, which would have been amazing, and I would have slept great, because I watched it hit, ping, and then vroom, like right back to $11. Like, man, that would have been nice. But nonetheless, so yeah, it was very quick. And at the same exact time, if we take a step over here, Bitcoin was like 3%, and ETH was like it hurts a little bit, 5%, but clearly not even remotely in the same ballpark as these alt tokens over here, which really reinforces sort of who kicked this thing off. And this is a blockchain. There's this kind of data is quickly surfaced by all the sleuths out there. And there's a few players at stake as to, they just, at the end of the day, they were dumping their alts because they don't want to be a part. They don't want to play a part in whatever's happening, and they want to figure out how to protect their business model. And just wait for the storm to blow over. But then there's also the panic that happens in here, which I obviously alluded to on my own terms as well, because I don't know, I had a lot of things on my bingo card, but 30% in a 10-minute time span, I as much as I've tried to position myself to be ready for these dips, that one was that was rough.
Yeah, actually, I kind of thought it was funny because, to be honest, I've pretty much divorced in my mind the whole relationship between the U.S. dollar and AVAX or any of these tokens. Once I really adopted the mindset of, hey man, validator is my goal, and I want to accumulate 2,000 AVAX. So anytime AVAX kind of drops down in my brain, I'm like, oh, I should get some more AVAX. It was kind of funny because I think I was talking to you in either the Discord or we were chatting, and I said, "Yeah, I'm sorry, I just don't think I'm ready to ramp up any more capital in crypto. I'm kind of moving on, and I've kind of hit the limits of the crypto capital that I want to put in there." And the first thought I had when I looked at this that morning was, "Oh man, should I put an order in for $10 AVAX?" Like buying was the first thing that crossed my mind, not, oh boy, we just lost 30% of the value in AVAX. What do I do? What should I sell? And that actually wasn't the first thing in my brain. The first thing was, oh man, should I put an order in? And then the second thought was, dang it, I just said I was all tapped out on capital, in slightly disappointment.
Yeah. Yeah, it was I was conflicted, and I'll get into the mentality behind this a little bit more later here, but yeah, I've talked about before how I've positioned myself to be what I think we can call delta neutral, but it's a very specific delta neutral in that delta on a liquidation scale of, if price drops, I don't have any risk of being liquidated and losing those funds. There's obviously value drop, and so it's not delta in that sense. But nonetheless, I've positioned that intentionally because, again, I started that now 100% ago almost when it was like $19 AVAX. I positioned it to be like, all right, this isn't going to hold. We're going down. I'm not going to worry about this. I'm just going to kind of lock my position here while we fall, so I just don't even have to worry about it. So there was a piece of me that had that same excitement, obviously paralyzed in the moment because I didn't get that scoop. But I did get the $11 scoop when it came back up, and I realized that was there. But there is one position that I have open that is on a liquidation threat. But I did position it, since we still have my chart up here. It was actually very interesting. I positioned that position that has a liquidation threat based on, this is the AVAX BTC chart. So this is the price of AVAX relative to Bitcoin. And this is important for reasons we can get into in another episode. I think it's interesting, but nonetheless, the important thing is it charts like a chart. And so I had just charted this white line as what I believe as a valid retracement from all-time highs. Just like anytime we talk about charting on the show. And at the time we didn't have this big drop here. So at the time I charted it, we had this gap here. And I was like, you know what? Let me just, for funsies, let me just check here and be like, okay, if we really get to the level that I have pegged here, I was like, all right, that's a 22% drop. And I was like, you know what? I should just be prepared. That would suck. But it clearly, look at this chart. This thing is just bleeding. And so this is the strength of AVAX against Bitcoin is just bleeding. And I was like, we clearly look like we're going to get down there. So I specifically went to that position that is at a liquidation risk and made sure my liquidation was below 25% price drop. And I'm happy to say, which is good, because I need to use the chain to modify that position. And in this crash, the chain was unusable because gas was so stinking high. It was like almost one entire AVAX just due to a simple swap between tokens, which is crazy. So luckily I prepared and I did not end up getting liquidated, but that was the one bit of panic was I was like, no, I don't want to lose that. And sure enough, I planned accordingly, which was great. So I had a little conflict of how I viewed this.
Yeah. Well, we'll see how that fares in the coming days.
I've mitigated since. I've now positioned it even more. So.
Oh, you ready for zero? Are you ready for zero?
As long as we
Charts
go there,
can go to zero.
Not all in one candle.
Okay. Yeah, but this brings us to kind of the discussion that I actually want to have today, and it's something we've really touched on before in the past, as far as being able to have multiple strategies that can be winners, and multiple people playing can come walk away and feel good about their trades. We've touched on it before on premium selling trades, where you got your buyer of the call and the seller of the call, and if each have different goals and objectives, an onlooker might look at it and say, oh, that guy was clearly the loser and that guy was clearly the winner, because they're looking at it from the perspective of what they view as the goals and strategies that that particular individual or trader should have, or they think that they have. And that's really kind of that second bullet is reality is really only relative. It's not absolute. And that kind of sounds a little bit strange. But what I mean by that is, take this drop in crypto. There is a huge amount of traders out there that were seeing this thing drop. And, there was legitimately people out there that were probably getting rid of this from the altcoin unregistered security angle. But I guarantee you that drove other traders who didn't necessarily share that same thesis, that same thinking, to say, oh my gosh, it's dropping, sell, 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 get out. And then you got people like myself and Viper who are like, ooh, we got a sale here. We can come in and buy some. And if you think about that for a minute, you're like, how is that possible that we have these two different individuals where they're making two perceivably polar opposite trades? And how can you tell me or tell somebody that, yeah, both of those guys could win? And that really kind of goes to this concept of the game that is being played. What's the strategy? What's the objective of those traders? And we have to ask ourselves, when we're looking at market action, when we're listening to some talking head on the TV, when we're reading an article, is what game is that trader playing? And what game am I observing? What is that? There are so many different things you can do in the markets, right? You think of it and say, hey, look, there's a game. Is that a basketball game? Is that a soccer game? Is that a volleyball game? And those have wildly different rules, wildly different objectives. If you go into the soccer game and you pick up the ball and start dribbling with your hands, you're going to get called for a penalty, right? And if you, as the onlooker, are not aware of what it is you're actually observing, you can perceive it incorrectly and think it's something that it's not. And where that kind of goes is that's really what drives bubbles, right? So we have these different bubbles that have occurred over time. And I think one of the most interesting aspects of bubbles is it's a confliction or collision of two different types of trade time horizons getting misunderstood and interpreted in incorrect ways. And so I have down here this statement that basically says bubbles are really when long-term investors start observing a game being played by short-term investors. Short-term investors, they're just trying to ride the wave, they're just trying to catch that thing, get up far up ashore as they can. They don't really care if the tide's coming in or tide's going out. They only care about the wave that they're in, right? They only care about the moment. They're like, hey, I think this is going up, so all I needed to do is go up 1 point from here, 2 points from here. It's all they care about. And so that drives a lot of action, that drives a lot of buying, and that kind of drives the price up. And at some point, when long-term investors start observing that and seeing that, if they don't have the respect and the understanding that some of that action could be driven by short-term traders with a completely different goal and objective, they could start getting worried that they're missing something. Maybe those short-term traders understand something I don't. Maybe they're smarter than me. Maybe they see something. What did I miss? And they believe that these short-term traders have the same goals and objectives of this long-term company valuation or things like that. And so they project their beliefs on those traders' actions, and they say, I'm buying. I got to buy. If these people think valuations are worth it, then I'm going to get in too. And then that, of course, further drives up the stock. But the truth is, those traders, those short-term traders, they don't care about valuations. They're just looking for that momentum and that movement. The error comes when that long-term trader has now projected his beliefs into the actions that other traders are taking. And basically then they get left holding this big bag of stock or shares of this equity for the wrong reasons.
Yeah, I feel like this hits home a lot in something I continually struggle with, and have mentioned before in our Discord, where I get different theses mixed up or signals crossed. I start reading the chart from I show up to the hockey game and I start watching the play. And then all of a sudden I'm like, oh, you should hit a home run. I try to project this expectation from the other game into this game. And it completely messes me up mentally. I screw up the play, and it's something that, I've gotten slightly better at, but I still struggle with because I still love hockey. I still love baseball. I still want to play these games. But doing it at the same time requires some ridiculous discipline. And so, I mean, that kind of also goes back to when we talk about when you're finding your own strategy, if you're just getting into this brand new. We've talked about picking one chart and following that one chart and, paper trading, risk mitigation, all that kind of stuff. That's really, really, really important when you're trying to learn the rule of one game, pick one strategy. It doesn't even have to be one you like long-term, but just learn it and then figure out if there's something else you want to go to. And so, that hopefully maybe will help. Because I didn't do that initially. I've just kind of been snowballing from one thing to the next, and that's just guaranteed signals are going to cross.
Yeah, and we know this comes across in our Discord actually, even because we have traders in the Discord that are much more price action oriented, short-term trade oriented. Look, I'm looking to catch this one swing here. There's other traders in the Discord. Spoiler alert, it's me, always trying to sell premium. And I'm like, look, this volatility is way up. I'm going to sell some volatility on this. And I'm selling a put or I'm selling a call. And someone will be like, yeah, I'm pretty sure this is going lower. And I'm like, hey, it might be going lower, but I'm cool if it goes a little bit lower. As long as it doesn't go way lower in this amount of time period, then I walk away as a winner. Yeah, that's probably bad for your swing trading strategy if it's not going to violently go down or violently go up or whatever it is they're tracking. But it's that whole situation of people are having a different perspective and a different strategy.
The last thing that, the way that it could even mess you up, a little bit more, like we were saying, as far as not knowing the game other people are playing when you see action on a chart. Because it might not be in direct conversation with somebody of what are you doing? And I think we talk a lot about earnings events and things like that. I think that's a prime example of where you could get panicked into that bubble situation, that worst case damage situation where we talk about news is noise and these binary events and earnings or a coin flip and all that stuff. But if you're really long bias on something and you go in to an earnings event and it dumps hard the next day, the short-term thinking was, the short-term play was, well, this is due for a retrace. This is due for a corrective swing, and we're still in an uptrend. But you have the long bias, and that bias was just 100% violated by this massive crash down, and then that's where you get tied up in, I got to sell, this isn't happening. And then you sell and then it keeps going up and now you're buying again. And now you're, it's just a snowball effect of disaster. So I think my point in that is just know what happens around what events and know what news could be toxic to you and your play. And in that particular case, if you got an extreme long-term upward bias to something, shut it out, shut all those events out, turn off the phone, turn off everything. Don't look at the chart, for, 3, 4, 5 days surrounding that event. Like, just start to pay attention to what does what and what you need to discount, not pay attention to.
Yeah, I want to visit this concept of bubble, right? I want to touch on this just a little bit more here. I want to give up two examples of bubbles where you retrospection, you're looking back and you want to call it out and be like, oh my gosh, what were you thinking? And we'll kind of go chronologically where the first bubble, right? The dot-com bubble, the internet bubble. And you're like, what were those people thinking? They were just crazy to think that these companies are worth, zillion times their earnings and price to earnings ratio and things like that. And if you go back to that dot-com era, what you really had was you had a lot of traders coming in on this momentum trade, this short-term trade, and trying to make money off this short phrase. But then because that attracted so much price movement and attention, you have these people that were fundamentally interested in the technology of .com and the promise that it might bring, saying, I need to get into this technology. And this short-term trading inflated this bubble, and those people got in because they thought they were missing out on something. They thought the train was leaving the station. And it goes to that intersection of incorrect biases or incorrect understanding of what's driving it. What's the other trader doing? And they perceived that all of these short-term traders must be looking at the books of the Oracles and the Yahoos and the Googles of the time, thinking, oh my gosh, these companies really are worth a zillion times their book value or their earnings value or their growth. And they're like, if they know it, they must have studied it. I must be missing it out. And so they bought in with a longer term time horizon because they mistakenly projected that these other short-term traders were sharing the same viewpoint as them. And we know that it was these short-term traders that really drove up that market, because during that dot-com bubble, there was absolutely insanely record volumes of shares traded, short-term options contract. Basically, every metric of a short-term trader was pegging all-time records back then. Even average mutual funds. And this is where we got that big collision of people. We talk about this bubble, and it's when the two time horizons collide and they think the other is doing something. And the average mutual fund during that time had 120% annual turnover. This is a mutual fund, right? This is more of a longer term steady. It's the type of thing you put in your retirement account. It's the type of thing that should be on a much longer time horizon. You don't get mutual funds saying, yeah, this mutual fund is going to day trade and make huge profits. You could have a day trading mutual fund, but it's not predominantly what they have. And when the average one has 120% annual turnover, that's a clear indication that slow money, longer time horizon is colliding and basically getting FOMO'd on that short-term action. The second example that I want to touch on is the housing bubble that came up in the early 2000s to mid 2000s, the housing crash. And you had a lot of individuals that were going out there buying houses, flipping houses, because the housing market started ramping up. I mean, sales were flying off the shelf, raising prices. People are like, I need in on this action. I don't really care what school district this house is in. I don't care what condition it's in. I don't care where this is going to be in 10 or 15 years. All I care about is, if I buy this house today, can I sell it next month for more money? And with the trajectory of the market, it absolutely was the case. And to give some numbers there, the quarterly number of houses that would transact more than once in a 12-month period in 2000, Q1 of 2000, that quarter, there was about 20,000 houses that basically flipped, that met that criteria of changing hands within a 12-month period more than once, indicating that the house had been flipped. During the peak or the end of that housing bubble in Q4 of 2004, that quarterly number had grown fivefold to 100,000 houses getting flipped within that same period. And what happened shortly after that? The bubble came out and it popped. And ever since that period, the quarterly volume of these houses flipping is around 30,000. That it's been. And that just in that time period, you have these people that, they just want to make a quick buck on the house. But then you have these other people that are like, I want to raise my family. I want to buy a house that I'm going to be in for the next 10 years, the next 15 years, 20 years. And they perceived that they were missing out on this bubble because they entered it because they thought all these other short-term people were, this market was going to sustain itself up there. And if they don't get in now, they're not going to get in at a reasonable price to raise their family. And that bubble fueled, it was one of the factors in the financial crisis and housing crisis of the economic collapse. And tons of those people that stretched to get houses because they tried to jump in on this short-term action under the mistake that it was the perception of those actions were from a long-term perspective, and they lost their houses. Foreclosures went through the roof, and all of that stuff. And so it really just kind of wanted to reinforce that bubbles aren't always from people being crazy. It's fundamentally from people not understanding what somebody else's perspective is. And, the one piece that I kind of want to tell you, like, well, why did they do it? Like, how does this happen? And I think this is really where it gets kind of interesting because in trading and stuff, there's so much actual psychology involved, right? It's more of a mind game of things. And to be honest, people are very self-centered. People are very much understanding of themselves, their needs, their wants, their goals, their objectives, and they just, I don't know what the right term is, but they just fail to recognize that other people might have other goals and objectives that are different than their own. A lot of this stuff is kind of called out very well in a book that I'm currently reading, and I kind of want to bring now to the closing this out a little bit around this book called The Psychology of Money. I highly recommend this book. I'm reading it myself, and there is just so much in this book that hits home for me. And this particular chapter where it was talking about this collision of, your perception, my goals, your goals, really is summed up that these two different investors that we're talking about, long-term, short-term, Bob, Alice, whoever they are, these two investors, they know that each other exist, and they're on the same field, and they're running toward each other, and they don't understand each other's perspective. And bolded out here is many financial and investment decisions are rooted in watching what other people do and either copying them or betting against them. But you don't know why somebody behaves that way. You don't know what makes them tick. You don't know their goals. You don't know their objectives. And that's a recipe for trouble. And I think that's something that we, Viper and I, have talked a lot about on this show, is know your own strategies. Have your own goals. It's fine to look at other people and see what they're doing. Ask them, why did you do this? Why is this? But never assume that they are playing the same game as you. Never assume that their strategy is to meet the same objectives as you. And so the biggest takeaway that I have from this is know what your strategy is. What game are you playing, and stick to it. You can observe other people, you can learn from them, you can watch what they're doing, you can inquire about it, but just recognize that they might not have, and most likely will not have, the same goals, objectives, and strategies as you. And we always refer to it as come up with your own flavor. And that's why Viper and I are always, with the trades we talk about, we try to lay out, this is the logic on the trade. This is why we took the trade. We try never to have our live trades posted, right? We'll go back and do retrospections away from the heat of the moment because we don't want you to copy us. We don't want you to try to say, well, so-and-so did this, so I'm going to go do this exact same thing. don't do that, because you're going to be assuming that I'm trading with the same goals and objectives that you have for yourself. And that's what is just a recipe for trouble. So yeah, Viper, I don't know if you have anything else to add here. I think it's highly recommend this book if you want to read something interesting, because there's lots of this is well said. Connects a lot of dots in my minds of things I think, but it's very well articulated.
Yeah, I'm definitely gonna have to check it out, because I mean, just the snippets, I mean, speak a lot to me and what I've learned so far and what I can 100% relate to. I mean, I feel like I've been pretty open about it on the show, as far as you know, even at a very high level, you know, not even necessarily specific trading styles, but you know, it was very clear to me through most of last year that I was trying to straddle, you know, the equities and this crypto exploration, you know, at the same exact time, and it was just, it was too much to keep track of, and two different games, and so, you know, like I said, having pulled my equities out so I could focus on the crypto exploration, but now at the beginning of this year, and well, I mean, really since fall last year, but realizing I still need to be in over in equities. I still, you know, am starting to get that now, you know, like I said, with the index mutual funds and stuff like that. Like I'm seeing the opportunity for recovery on those. So I still want to be in there, and thus devising my own strategy of, I'm going to do this very fundamental, simple exposure in equities that allows me to then keep focusing on exploration and learning this whole Wild West news space. And that's just, you know, just my personal example of how I ran into that same exact problem. Something had to break, and I wasn't going to let it be my will to participate across the board. But I needed to come up with a compromised solution that allowed me to just stick to my plan, stick to my thesis, and what's important for my time horizon.
So that brings us to the end of this week's episode. I think, you know, it was a nice tie-in to see like how a broader market reacts to a big event with the, you know, altcoins and unregistered securities, and these big players that have one objective, and that objective is, I'm here to participate in the altcoin trading. That's at jeopardy. I need to get out. I need to sell. Selling action begets selling action, which attracts other people in danger, where people with longer term time horizons can get kind of sucked into those shorter term things. It's very important to remember that people have different objectives, right? That thing dropped 30% in a matter of hours. And what's the first thing that a lot of those people did was sell, 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 get out, get out, get out. And then people like myself and Viper see that, and yeah, we're a little bit like, oh, bummer, that kind of stinks. But, you know, the first thought in my mind was, ooh, I should buy something. And it's just goes in the reinforces the idea that completely different perspectives on the exact same event and the same reality. And the reality and the way that it's perceived is 100% relative to the observer that is looking at that. And so tying that into everything that we always talk about is not, don't ever copy, don't ever blindly follow. Understand what is going on underneath the hood, what makes the machine go, what makes the machine tick. That fundamental understanding of the why really is the empowerment to you, the trader, to form your own things, build your own constructive strategies, find your own flavor, observe lots of people, ask them, why do they do what they do? How do they do what they do? Gather that data, but don't ever blindly copy and blindly follow, because you'll never understand what their goals are. You'll never understand their objectives from your vantage point. You will always be different people. And recognizing that really will go a long way to what I consider your trading maturity and your ability to learn and react and pivot out there in the market and profit to a lot of respects, because if you're always lagging and you're always following and you don't know why you're doing what, you'll never be the leader. You'll never be the person that comes out on top. And you're likely to be that kid during musical chairs that's like, oh, the music stopped. Where's my chair? And that's not where you want to be. So I hope that that is a little bit of thought for you to consider, and, seek out that knowledge, seek out that information. A lot happening in the markets. I have been really putting a lot of different trades on, and they're all on thetagang.com. They've been working out pretty well from my perspective of my goals and objectives of premium selling. So hopefully you can find the trades that fit your style and your strategy and have a great time doing it. And I hope they're bringing you profits. And remember, think outside the block.